Trial balances play a pivotal role in the world of accounting, ensuring the accuracy and integrity of financial records. These reports provide a snapshot of an organization's financial position at a specific point in time, showcasing the closing balances of all general ledger accounts. But have you ever wondered how trial balances are created? What are the key components that make up this essential accounting tool? In this video, we will delve into the intricacies of trial balances, exploring their purpose, structure, and the step-by-step process of constructing one. So let's uncover the secrets behind trial balances and empower ourselves with a deeper understanding of this vital accounting concept. Unlock the secret to financial success with Counting Coins, where numbers come alive and your accounting game thrives. A trial balance, often abbreviated as TB, is an accounting report that showcases the closing balances of all general ledger accounts at a specific point in time. In the days of manual accounting on paper, the trial balance served as a crucial tool to ensure the accuracy of the financial records. The goal was to match the total debit balances with the total credit balances. However, with the advent of modern accounting software, this reconciliation process has become automated. Consequently, the primary purpose of the trial balance has shifted. Nowadays, it acts as an internal document that helps accountants identify errors and aids in the production of financial statements. Auditors also utilize the trial balance to determine which accounts require further scrutiny during the auditing process. To visualize a trial balance, imagine a comprehensive listing of all general ledger accounts arranged vertically on a page. Each account is accompanied by two columns, one for debit balances and the other for credit balances. It is important to mention the period and date in the title since the trial balance captures a snapshot of the financial position at a specific moment. The accounts are typically grouped according to their classification. The standard practice is to begin with assets, followed by liabilities, equity, and dividends, mirroring the layout of a balance sheet. Next, revenue and expense accounts, which comprise the income statement and profit and loss, are listed. To enhance clarity and reduce clutter, accounts with zero balances are often omitted from the trial balance. Additionally, the placement of balances in the columns aligns with the normal balances of the account types. Remember the acronym DEALER. Dividends, expenses, and assets are usually debit accounts and appear on the left side, while liabilities, owner's equity, and revenue are typically credit accounts and appear on the right side. A balanced trial balance indicates that the total debits match the total credits. However, it's important to note that while a balanced trial balance is a good starting point, it does not guarantee the absence of errors. There could still be mistakes in the individual entries that offset each other, resulting in a balanced trial balance but inaccurate financial records. To gain a better understanding, let's explore an example of building a trial balance for a fictional landscaping and lawn care business. If you've liked the video so far, please give it a like, subscribe, and let us know in the comments what you would like us to cover next. Now back to the video. Let's delve into the process of constructing a trial balance for our landscaping and lawn care business. In order to create our trial balance, we'll utilize a concept known as a working trial balance. This format is quite similar to the one previously described, with one key distinction: the separation of debits and credits into separate columns. Instead, we'll distinguish debits as positive numbers and credits as negative numbers to differentiate between them. Let's go through the steps together. Step 1. Listing accounts and adding columns. Start by listing all the accounts associated with our landscaping and lawn care business. Once the account list is complete, add 7 columns to the right side. These columns will help us record the journal entries and calculate the total balance of each account. Additionally, create the final row below the account list for the column totals. This will assist us in verifying the balance of each journal entry as we enter them. Step 2. Entering journal entries. Now let's proceed with entering the journal entries. I'll walk you through each entry briefly. 1. The business owner invests $100 and in return, the business issues $100 in stock. Debit cash by $100 and credit owner's equity by $100. 2. The business takes out an additional $200 loan to support its activities. Debit cash by $200 and credit loans payable by $200. 3. The business spends $30 in cash to purchase lawn care equipment. Credit cash by $30 and debit equipment by $30. 4. It spends an additional $50 on supplies, making the payment on account. Debit supplies by $50 and credit accounts payable by $50. 5. The business earns $150 by landscaping, utilizing half of its supplies. Debit cash by $150 and credit revenue by $150 to recognize the income. Additionally, credit supplies by $25 and debit cost of sales by $25 to account for the portion of supplies used. 6. Lastly, the business incurs $20 in costs to repair its equipment. Debit repair costs by $20 and credit cash by $20. Step 3. Computing totals. Having entered all the September journal entries, we can now compute the totals for each account. As you sum up the totals, you'll notice that the sum is 0, indicating a balanced trial balance. Before wrapping up, let's make one final adjustment. Reformat our working trial balance by separating debits and credits into distinct columns. Additionally, let's rename it Trial Balance for the period ended 30th of September. Now, with the debit and credit columns clearly indicated, we have our final trial balance for the September accounting period. To summarize our journey through the trial balance, we have learned that it is an accounting report that reveals the closing balances of all general ledger accounts at a specific point in time. Its primary purpose is to assist accountants in detecting errors and facilitating the creation of accurate financial statements. A balanced trial balance requires the debit and credit column totals to match exactly. However, it's crucial to understand that a balanced trial balance doesn't guarantee the absence of errors within the individual entries. And there you have it. Trial balances are essential tools in accounting that ensure the accuracy of financial records and aid in the preparation of financial statements. While a balanced trial balance is a good indication, it doesn't guarantee error-free records. By understanding the purpose, structure, and process of creating trial balances, we gain valuable insights into maintaining precise financial data. So let's utilize this knowledge to navigate the realm of accounting with confidence and precision. So, now that you've gained insights into the importance of trial balances in accounting, how do you plan to apply this knowledge in your own financial practices? Are there any specific challenges you foresee in creating trial balances? Don't forget to comment below with your thoughts, questions, and accounting victories. And make sure to hit the subscribe button and turn on notifications. So I'll see you in the next episode of Counting Coins. Happy accounting!